Hi everyone, welcome to lecture 2 for Eco 208. This lecture is going to be about measurement, so measuring macroeconomic variables. And it's not obvious how to measure these things always, because you think about it, these are aggregate variables and we're aggregating many different things. So the aggregate price level is the aggregate of many prices, or GDP is the aggregate of many different goods. But then we boil them down into a single number, whether that's GDP, whether it's aggregate prices. And so sort of a priori, it's not obvious how to do this, but we're going to talk about the methods that macroeconomists use to do this kind of measurement. So we're going to start with maybe the most obvious one, which is gross domestic product. And really here I'm talking about nominal gross domestic product. And in the next section, we'll talk about real GDP, real gross domestic product. So consider the following questions. How much did the economy grow in the past year? How much did output shrink during the 2008 recession? How much greater are incomes today than in 1900? So as I kind of foreshadowed, these all require some measurement of aggregate economic activity. So take either the first or the second, we're talking about aggregate output. And this is really the combination of many different goods. So, for example, what if last year production of some number of goods grew and production of some others shrank? Could we say that aggregate output grew? Did the economy grow? Could we say that aggregate output shrank? Did the economy shrink? And so it's not obvious how to add up these things. It's like adding up apples and oranges. And the most common solution is to weight the production of different goods and services by their prices. So we're adding up the production of many different kinds of goods, but we're assigning them a weight that is the price at which they sell in the market. And this is what gross domestic product is. It's the dollar value of goods and services produced during a given period of time within the borders of a country. So this last phrase really tells us that this is a sort of countrywide measurement. This is a measurement of production in a given country. And so in Canada, this is published by the National Income and Expenditure Accounts. And in the US, you would find it in the NIPA, as it's called, the National Income and Product Accounts. Now, there are three approaches to measuring this. And in practice, as I say at the bottom, all three measures should add up to the same value, although you might get some differences due to measurement error. Now, the three approaches are the product or value added approach. So this is the sum of the value added to goods and services in production across all productive units in the economy. So this is sort of what I alluded to before. You're summing up production, valuing that production at its price, and once you do that, that gives you GDP. And we'll do an example in a second. There's also the expenditure approach. So this is the sum of all spending on goods and services in the economy, or the income approach, which is the sum of all incomes received by economic agents contributing to production. And now the reason these should all be equal is because production is equal to expenditures is equal to income. So to give you the briefest of examples, imagine that I produce a chair to sell, and I sell it to you. Well then, what's the value of my production? It's the value of that chair I sold. It's the price you paid for that chair. What's your expenditure on it? Well, it's the amount you spent. It's the price of the chair. And what's my income from selling that chair? Again, it's just the price of that chair. So every time something is made for production, it's both produced, bought, and sold. And we measure all these things at the same price, which means that production is equal to expenditure is equal to income. And therefore, these three approaches really these three approaches really are the same. So in order to understand these, we're going to do a very simple example. So we're going to have a simple economy in which people only consume coconuts. And this is a thing economists like to do. They always like to think about economies. There are always these desert island economies where all you can eat or consume is coconuts or something like that. So in this case, we have an island economy. All they eat is coconuts. And there are a few different sort of agents that we have to think of. So there's the coconut producer, that's a firm, and it uses labor to produce coconuts. Okay, so it's going to hire people and they're going to pick coconuts, and that firm sells these coconuts. There's also a restaurant which uses labor and the coconuts that are harvested by the coconut producer to produce meals. So although I could buy a coconut from the coconut producer and just eat it, some people might like to go to a restaurant and have coconuts the way they're prepared at the restaurant, like coconut soup or, I don't know, mojitos, I don't know. Then we have consumers and workers. So they supply labor, they consume coconuts in restaurant meals, they provide loans, and they receive profits. And we also have a government who's going to tax firms and consumers or workers, and it's going to use labor to produce government services. In particular, the government is going to produce national defense for this island economy. So let's look at these in detail. So we have our coconut producer. And so, as we said, it's going to sell coconuts and receive some revenue from the selling of these coconuts. And so we value, or this revenue is valued at $20 million. And so in particular, they're going to produce 10 million coconuts, which are sold for $2 each. So $2 times 10 million coconuts, $20 million in revenue. And some portion of these, so 6 million coconuts, are sold to the restaurant. So they're going to sell these 6 million to the restaurant, where the restaurant will use them to make coconut-based meals. And 4 million are going to be sold to consumers directly. So some consumers might just buy their coconuts directly from the coconut producer. Because they're harvesting these coconuts with workers, they have to pay wages. So they're going to pay $5 million of wages. They also take out loans to who knows, to maybe pay for some kind of tools or something used in the harvesting. So they owe money on these loans, and they also pay taxes to the government. Our second firm is the restaurant. So it also receives revenue from meals, okay, so from selling what it produces, which is these meals. And so it sells $30 million worth of meals, and that's its revenue. To do that, it has to buy coconuts from the coconut producer. And remember, the restaurant buys 6 million coconuts at $2 each, and so the cost of these coconuts is $12 million. They also employ workers, so they have to pay wages, and they also pay taxes. Importantly here, for the purposes of calculating GDP, these coconuts that the restaurant is buying are referred to as intermediate goods. Okay, so they're not producing those coconuts. They're using them as an input in production. And finally, we have the government, our last productive unit, okay, which receives taxes both from producers and from consumers, seen here. And then it pays wages to workers who supply national defense for the economy, who keep the economy safe by, I don't know, working in the army. So these are our three productive units. And so immediately, knowing the values of this production across these productive units, we can do our first approach for calculating GDP, which is the value-added approach. So just recall, the value-added approach is the sum of value added to goods and services in production across all productive units in the economy. And value added is really just the final sale price minus the cost of intermediate goods. So, for example, in the case of the coconut producer, although they have a revenue of $30 million, part of that revenue is just covering the cost of the intermediate goods, i.e. the coconuts that they buy. And so really their value added, as we'll see in a second, is going to be the difference between those two. So let's think about this. What's the value added of each of these productive units? For the coconut producer, it's the value of final goods sold minus intermediate inputs. Well, the coconut producer doesn't have any intermediate inputs. They do pay workers, but that's not an intermediate input. Intermediate inputs are the costs of goods bought to be used in production. So they have $0 of intermediate inputs, and therefore their value added is just 20 million minus 0, or $20 million. What about the restaurant? Well, the restaurant sells their goods for $30 million, but they purchase $12 million worth of intermediate inputs. They purchase $12 million worth of coconuts from the coconut producer. And so therefore their value added is $18 million. Finally, we have the government, who also has no intermediate inputs. One might wonder how they're providing this national defense. They don't have any weapons, I guess. But in this story, they have no intermediate inputs. And we value what they produce, i.e. national defense, at the cost of their production of this national defense. Notice quickly, and this is important, that this is different. How we value the value added of the government is different than for the two firms. For the firms, we're valuing the value of final goods as their revenue, i.e. it's how much they sold all their goods for on the market. Because the government doesn't sell its goods on the market, we value its production at the cost to produce it. In this case, $5.5 million, which was the cost of paying wages for workers in this national defense. So when we sum these up together, we get a GDP equal to $43.5 million. What about the expenditure approach? Well, so this is the sum of all expenditures on final goods and services in the economy. And perhaps you remember from first year macro, this is just consumption, C, plus investment, I, plus government expenditures, G, plus net export, 0. Now, luckily for us, in our economy, there's no investment and there are no net exports. And so we can kind of eliminate those from our equation, and we're left with GDP is just equal to consumption. So our consumers are buying things. They're buying coconuts in restaurants. And government expenditure. The government is spending money on providing national defense. And just to make things simpler, we can break down this consumption by consumers into consumption of coconuts and to consumption at the restaurant. And so quickly, let's go through our example again and we'll pick out the numbers for this. So, consumers purchase 4 million coconuts directly from the coconut producer at $2 each. So therefore, there is $8 million worth of consumption from the coconut producer. They also buy $30 million worth of restaurant meals. So that's another $30 million worth of consumption. And for the government is spending money to provide this national defense. And again, we value that production or that consumption at the amount that it's paying to provide it. So $5.5 million worth of wages to provide this national defense. So if we plug those in, what do we get? We have $8 million from the coconut producer, $30 million from the restaurant, and $5.5 million from the government, and we sum those together and we get $43.5 million once again. Moving on to our last approach, the income approach. So this is the sum of all incomes received by economic agents contributing to production. So it's the sum of wages, profits before we remove taxes. So that's before tax profits, and interest income. So let's just look at this one more time. We'll go through these slides one more time and pick out the necessary information. So the coconut producer pays wages of $5 million. And it also pays interest on loans. So this interest payments on loans are also someone's income, right? They're the income of the person who offered the loan, which in this case is the consumers. And we'll come back to, obviously, this coconut producer also earns profits. And we'll come back to that in a second. But for the time being, we see that they pay $5 million worth of wages and $0.5 million worth of interest on loans. The restaurant pays $4 million worth of wages to workers. They have no loans, so we can forget about that. And they too have profits, which we'll come back to once again. And then what about the government? Well, the government pays wages, pay $5.5 million worth of wages, but they don't pay any interest on loans. They have no loans, and likewise, they earn no profits. So now, coming back to profits, Recall that what's important for us here is before tax profits, not after tax profits. So we're not going to be subtracting taxes. So in particular, before tax profits are my total revenue minus all my costs. So minus my wages, minus my interest, minus any cost of intermediate inputs. What's left over after that is my profits. And so if we do that, we do those calculations and we add them together, we get a total profit in the economy, total amount of profits of $28.5 million. So let's sum these all together. So GDP is equal to wages, to interest income, and to before tax profits. So it's $14.5 million worth of wages, $0.5 million worth of interest, and $28.5 million of before tax profits. You add those all together, you once again get a GDP of $43.5 million. Now, what about GDP in Canada? So here we have it for the year 2017, broken down by the different kinds of expenditures. So broadly, we have consumption, investment, government expenditures, and net exports. And each of those categories is divided even further into subcategories. So there are a few things interesting to note here. One is that the largest category of expenditure by far is consumption, which makes up almost 60% of GDP, which is way more than 20% for investment, 25% for government expenditure, and was almost zero for net exports. More importantly, when we look at consumption broken down into the subcategories, notice that the largest subcategory is services, and that's compared to durable consumption, so that's the consumption of things like cars, semi-durables, you can think of clothing, or non-durables, things like food or gasoline, which we consume immediately. The largest is services, and if you break down these services even further, you'll see that the majority of this is going to housing payments, so either to rent or to payments for housing. In terms of investment, we can break this down into non-residential, so that's the investment of firms, for example, in plant, equipment, and machinery. Residential, which is the expenditure by households on homes, houses. Changes in inventories and intellectual property. Government expenditure can also be broken down into consumption and investment. And then, of course, we can see that net exports are so low because exports almost are equal to imports in the case of Canada. So this is the measurement we use, and it has some problems. And mainly its problems derive from the fact that people like to use GDP as a measure of well-being, as a measure of welfare of a country. So in particular, you'll often hear people say, this country has a high GDP per capita, a high level of GDP per person, and therefore it's developed, it must have a fairly good standard of living. And although this is fairly good approximation, it's not necessarily the case. And so there's a few reasons why. For one, you can imagine this doesn't take into account inequality. You could have the same GDP per capita between two countries, but have vastly differing levels of equality or income inequality. So for example, here, you can imagine an economy where there's two people both earning $90, have a GDP, both earning $50, has a GDP per capita of $50. On the other hand, you could have an economy where there's one citizen earning $90, the other earning only $10, and the GDP per capita is the same. But these two countries have very distinct standards of living, especially depending on who you are, whether you're the rich person or the poor person. Another important aspect is non-market activity or home production. So you can imagine that GDP accounts for everything that's bought and sold in the marketplace, but not everything we consume is bought and sold in the marketplace. So you could go to the store and buy a loaf of bread, and that would be counted towards GDP. Or, much as I did last night, you could make your own loaf of bread, And when you do that, the labor going into making that loaf of bread isn't counted towards GDP, even though the end result is the same, which is me consuming a loaf of bread. And so, in so much as a country does more home production, it'll tend to bias its measure of GDP downwards. So in particular, developing countries tend to do more home production. They tend to produce more things in the home rather than buying them on the market. And so the gap between the GDP of developed countries and developing countries is amplified in this way because people in developed countries tend to buy more stuff in the market. And so that inflates the measured GDP of these countries. You also might imagine that there's some economic activity that's not reported. So for example, illegal activities or tax evasion. So people working and not reporting their income for the purposes of not paying taxes. And in both of these cases, although these are supposedly productive activities, we don't have a measure of them. It's hard to ask a drug dealer how many drugs they're selling in a year and at what prices. And so we just don't have a measure of these things. Likewise, and I alluded to this earlier, how do we measure the value added for government services? So as I said before, for firms, we measure their value added by the price that people are willing to pay in the market for what they produce. But we can't do this in the case of government services, which just aren't sold in the marketplace, right? So no one buys national defense in the marketplace. In Canada, very few people buy education, primary education, and people don't buy healthcare. So how do we value these things? So what we end up doing is we use the cost of production rather than how much it would sell for in the market. And obviously this can lead to undervaluation or overvaluation. So in particular, in the overvaluation case, you can imagine that the government produces something that no one uses. Maybe because of corruption, it builds a bridge somewhere that no one drives over. Well, that's still valued at its cost of production, even though if it was sold, for example, on the marketplace, no one would have paid for it. And likewise for undervaluation, and this goes to my last point, it really matters what's being produced because some goods may have positive or negative externalities and some goods may lead to higher amounts of welfare than others. So you can imagine an economy that's at war and spends a large portion of its income on producing guns and bombs. This is very different for the same level of GDP of in a country that is consuming bread or vegetables or going to movies. These are very different activities. And although we value them both by their either cost of production or value in the marketplace, they're very different activities. And here I also have that some activities like education may incur significant positive externalities, which we're not counting in this measurement. Now I come to my first tweet. So I have collected tweets which I will put throughout the lectures in cases where they're relevant, just to show you that some of the stuff we're doing at least is very relevant to things that are going on currently. So these are tweets I would have collected in the last few weeks, or even more recently, that are relevant to the things we're talking about. So this one comes from Justin Wolfers. And so this is about the following. Despite being in a health pandemic, healthcare expenditures had a negative impact on US GDP in Q2. So in other words, even though the US is currently facing a health pandemic with COVID-19, the amount recorded in GDP as being spent on healthcare has gone down, which seems counterintuitive. You would expect because we're in a health pandemic or because the US is in a health pandemic, it should go up. So what accounts for this? Well, Justin Wolfers tweets the following. He says, perhaps this points to problems in GDP. We stopped elective procedures to preserve capacity for COVID patients. So he's saying here, hospitals stopped offering elective procedures, so non-necessary procedures, so that they could increase capacity for people suffering from COVID-19. And he says, creating COVID capacity is productive and important. obviously. However, he says if the government had paid hospitals to do this, it would count towards GDP. It didn't, so it doesn't count as GDP. So here, even though creating this capacity by no longer bringing in patients for elective procedures is productive, it's not counted because it's not an expenditure. And so we're really missing this major aspect of GDP, which could be a problem.